You're watching News.Markets. Volkswagen is in big trouble. Its 2-litre clean diesel engines used in more than 10 million VW and sister brand cars over the past decade turned out not to be so clean after all. Shares tanked, wiping a third off the automaker's value. Heads rolled. Can Volkswagen survive? We're here to talk about reputation and how strong brands can protect companies and chief executives against mistakes. I'm joined by David Haig, founder and CEO of Brand Finance. Well, thanks ever so much for coming in. Is the worst over for Volkswagen, or do you think there's more to come?
I don't think the worst is over by any means, no. I think that the American authorities are highly likely to take criminal proceedings against the directors. I think other authorities around the world will find similar problems, and I think it will get worse.
So is this the end of the brand as we know it?
It's always possible to revive brands if you manage the process well. When Toyota ran into problems in 2011 because they had cars that had brakes that stuck and caused various crashes, they prevaricated for a little while, which caused a bit of a run on the company, but then they got their act together and they ran a casebook in how to run crisis management. So they did it okay, and they have come back.
It really took some time, though. It did take time.
It did take time. It took about 4 years before they were really back to where they were, but they're now #1 in the world. And the question is, can Volkswagen do the same?
So that's a recovery story, but then think of companies like Ratner's.
Yes.
Well, that went horribly wrong.
Ratner's was a much smaller company, and fundamentally the CEO torpedoed the whole thing, so it went bust. I don't think Volkswagen is in that bracket. You know, of their 10 million cars, only half go under the Volkswagen brand name. The rest are a whole load of other brands, which I think will probably avoid contamination. The question is, can they actually do the right thing now for VW?
You talk about the other brands. One of those, of course, is Porsche, and many people might not realise that the proportion that Porsche is of that umbrella company. Might we see a rebrand using that name?
Well, I don't know. I think it probably makes sense. But, you know, it is one of those things where if you look at a company like Diageo or P&G or Unilever, you have a corporate brand name separate from the individual product brands, and that prevents contagion, because if one of your product brands goes haywire, it isn't actually going to be synonymous with the corporate brand. So there's a very good reason for having a corporate brand different from the product brands. So Porsche would be a much better name now for the Volkswagen group, but would that be a high risk? Perhaps they ought to have a brand new name completely.
Let's think of some other companies who've been through the mill, to say the least, in the last few months and years. Tesco comes to mind there.
Tesco, yes. Well, Tesco clearly had a lot of major problems.
One after the other.
I think one of the problems with Tesco is that they had been pushed so hard to get market share. You know, it got to the point where £1 in every £7 spent was spent at Tesco. You couldn't go any further. So all of the problems that they ran into, fiddling the books, were because the executives were all under pressure to try and perform. That has now been revealed, washed away. No customers really suffered. It was a financial issue, and I think they will recover as a brand. But in this case, with VW, consumers are suffering.
Do you think that investors care about who the CEO is, who stays and who goes?
They definitely care. You know, the fact that the shares rebounded by 5% when Martin Winterkorn resigned demonstrates that it makes a difference. It must always be a bit demoralising, mustn't it? You know, when you join a company and the share price tanks, or you leave and it goes up. But, you know, that's a fact of life. The leader is important. Oil,
banking, these are sectors that have been really battered. Well, are there any shining beacons of light?
Oil and banks are the classic examples, and you know, I suppose the real question is whether or not they're accidental mistakes. They can be bad. You know, like the spillage in the Gulf was an accident, and it wasn't handled very well to start with, but eventually they got their act together.
So it was a double whammy, because they were hit by something happening to them,
yeah.
But then the way this chief executive handled it, asking for his life back.
Yeah, exactly. It was
didn't do
very
them any
badly
favours.
And they were caned by the US authorities. They've paid out. They've kind of recovered, but they're probably a takeover target now. Whereas in the case of the banks, they were sins of commission. You know, they actually instigated things like LIBOR fiddling, and so they have been much more heavily hit.
But when you think about it here, that negligence, that turning a blind eye to certain technicalities. That seems to be playing out with the Volkswagen story.
Well, it'll be interesting to see. I mean, it's beginning to have the impression that it was actually a policy constructed at board level and passed all the way down the line. It's very hard to imagine a German company not having command and control, so it makes you think, you know, for it to have happened randomly in another company you might believe, but I'm not really sure you would believe that of a German company.
Because German companies, your brand index, rate quite highly. Well, look, David Haig, it's been an absolute pleasure talking to you. I'm sure we'll revisit this sometime soon. David Haig from Brand Finance, thanks so much.